and just give me a second. And this is basically one of the many micro E-mini. It's one of the 4 micro E-mini futures from CME Group. With us today, we also have a representative from CME. So if you have exchange-related queries, please feel free to type them into the question box. All right. So we're going to be covering in greater detail about this contract, so you understand the contract aspect, as well as how you could possibly do technical analysis, and also how you can keep an eye out for specific formations to let you know, to indicate when's the right time to get in. And Kon Hao will also be covering the theory with a case study using a 50-minute chart. All right, so first and foremost, before I hand the reins over to Kon Hao, can I just do a quick check? Can you hear me clearly? Great. Thanks for letting us know they can hear us very clearly. For those of you who can't, I'll probably type in the chat box and suggest that you unplug and replug in your headphones. All right. So without further ado, let me hand the reins over to Kon Hao. Kon Hao, if you're all set, it's all yours.
Okay, thank you, Sri. I think now it's also my turn to check the audio. If you could hear me, just maybe send me a chat, or you can hear me clearly. Okay, so I believe you could hear me clearly. Okay, that's great. So I'm just going to start straight away. I think today I'm very excited to share. I think this is the first time I share about the small cap, and I always wanted to share about small cap. So of course, while in the preparation of prepare for tonight, I did some research and I dig in even deeper, and to my surprise, finding what I know about small cap, what I perceive about small cap, that leading the major indices is so true. And tonight, I'm just going to present to you not just the chart, and just to clarify, not 15 minutes chart, but a longer time frame chart. That I'm going to present some data and as well as chart. Why is it so? Now, before that, I just want to thank a 3 party. The first party will be our sponsor tonight, CME, especially to Miss Rachel Wong. Thank you so much for inviting me to share on this mini Russell about, or the Russell index, or the small cap US index. How is it leading the world? Okay, so you may be scratching your head right now, but let me just present to you in this short 1 hour. Now, the second group of people I want to thank is really the behind the scene, remotely beside me, but remotely, Sri and his team, and of course Phillip Futures for hosting this program. And last of all, I just want to thank you all for tuning in. Now, so just to give you a brief summary, what am I going to discuss tonight? I'm going to break down into 2 parts. The first part is that in a bull market, if you have observed, or maybe you have not, in the bull market, a typical bull market is that first you see the blue chips start to move. And at the end of the bull market, you will see the catch up from the small cap. So we're going to discuss about the relationship. We're going to see that. And how about a potential bear market? In a potential bear market is the reverse. And the first signal that we're going to see first is the small cap start to sell down. The smaller guys start to sell down, including the listed ones, because Russell 2000 are all the small, medium-sized cap companies. In a potential bear market, the small cap will start to sell down first, and then later by the blue chip. So this is in the whole aspect. This is what we're going to discuss tonight. Okay, so I'm just going to move on to the next slide. And it's okay, so I want you to stay focused on the bottom. I think Sri just did a wonderful introduction. Want to know more about me, just go to the bottom right-hand corner. So as I move along the slide, I will also include all these link at the bottom right-hand corner. You can just take a snapshot, and I'm going to give you the slides anyway. So you can take a snapshot. So after the presentation, you can go and research about it. So you can find out more about me through this link. And also, tonight, what I'm going to do is very interesting. When I'm really thankful for CME to give me the opportunity to share this, because when an opportunity is given, when I do into research, I also find a lot of new things as well. So whatever I do to present to you tonight, you have to understand that I am not in the I'm not positioning myself to recommend anything to you, but rather I will share with you my experience, my insight, my research, and I hope that is for educational purposes. It's not a recommendation. It's not from me. It's not from Phillip Futures. Neither it is from CME. Okay, so if we are good, then we are good to go. Okay, so if you take action tonight or next week or tomorrow, you have to understand it's your own responsibility. Okay, I think I make this stand, then we have to move on. Okay, so before I go, CME prepare. In fact, they have developed this in their website. They have developed this price action alert. It's a 1-minute clip. Do watch it. So do subscribe to it so you can punch in all the alert that you may want. Then they'll keep you very alerted. Okay, let's watch this 1-minute clip. What are the features that they're offering?
What if you were alerted when a significant price movement occurred in a CME group market and provided with historical analysis of subsequent price activity? Based on historical activity, alerts are generated for 3 price events. When the price moves above or below the 20, 50, or 200-day moving average. When the price moves 1 standard deviation above or below the 5-day moving average. Or when the price moves 1 to 5% above or below the previous day's settlement price. When a price event occurs, an alert is generated with the details, including relevant historical analysis. Clicking on the alert allows you to dive deeper into the historical data analysis. The historical data provides the percentage of time the market price has subsequently increased or decreased in the average and maximum price movements. The most significant analysis from the historical data is highlighted for easy reference. You can subscribe to CME price action alerts for any of CME Group's top products. Alerts can be sent via email or push notifications through the CME Group mobile app. CME price action alerts combine real-time price events with the power of historical data, enhancing your ability to make efficient, informed trading decisions. Subscribe today.
Just send me a text if you can hear me. Now, if you have missed out the first part, my apologies. You can always go to the link stated below and you can get hold of the same video again. Okay, let's go to the topic for tonight. Now, feel free to ask questions, but I will not take any question until I end my presentation. So you have a whole structure of things, how to look at small caps index. But however, you can still submit your questions. So beside me and remotely, yeah, I got the request here a bit soft, so I speak a bit louder. And Sri will be taking marking down all this question at the end of it. Okay, let me just unplug. Can you hear me better right now? Is it louder?
Yes, it's much better. Much better.
Yeah, so I will use the other mic then. Now, so you can submit your question, but I will not be taking any of the question until the end of the presentation. But what will happen that Sri will collate all the questions at the end of it. Sri will ask me the question on behalf of you. So this is what we're going to do tonight. And if you want the handout, you can subscribe to or write a QR code, send in your request. And at the end of this presentation, allow me to have my dinner first. Then after that, I'll send you these slides, okay, for your reference if you find that it's really good and it help you to understand what is this small cap index all about. Okay, so the first part I want to share with you is a bit of the market outlook, what I feel, what I see. I just felt that the recent move, what we experienced since the beginning of January, is very similar to what we experienced in 2008. Okay, if you're not entering into the market in 2008, it's okay. Let me just give you a recap of what happened in 2008. Now, so there's a lot of similarity. I could see that in 2008, there were 3 waves, moving down waves. And today we experienced the first wave, but I'm not exactly sure we're entering into the second wave or the third wave. And this is what I'm going to present to you. And later on, we're going to touch on the Russell, mini Russell. Okay. Now, so this was in 2008. As you could see, in 2008, market was trending along very nicely before the what do you call that, the credit default swap or the subprime crisis. Market was trending along very nicely. Then something happened, the subprime crisis. Now, something I want to take a note that one thing I'm good at is that my company, what we're doing here is that we study into the unusual behavior. Yeah, we try to make sense of things. So we work with exchanges, regulators, even the lawyers as well. Now, so what happened here is that you could see that because of subprime or credit default swap, the market sold off about 20%, close to 20% within 2 months. Okay, now you have to understand about behavior science is this. When the market dropped too much, too quick at a very short period of time, and the market are not don't have sufficient time to react to it in terms of fiscals, monetary policy, union, to help the companies. So this was what happened that in 2008, there was this crisis subprime. It happened in 2 months. A 20% drop happened in 2 months. Now, let me give you another perspective. If it was a 20% drop within 1 year, then it's all right. The market will, given time, the market will find its way to get things around. But when everything happened too short at a time, it became a shock. Some of the companies or even some of the government or central bank, they are not ready to absorb this kind of shock. Now, then after that, that was in 2008, we see and we witness, if you cannot remember, let me help you to recall here. The market recovered very strongly. Now, but the truth was then the core issue, which is a subprime or credit default swap, is still there. It hasn't gone away. The problem is still there. Then after that, when the problem is still there, it follows by a wave of companies. It's not just listed, but the non-listed private companies, the weaker ones, start to fall. So when they fall, many of them, they affect the stock market, of course. Then we have this term called the Wall Street meltdown. So in 2008 crisis, in short, it's called 2008 crisis, but there was 3 waves: the subprime crisis, the Wall Street meltdown. So what happened then was, as many company fails, and of course they fail to pay their loans, their borrowings, then they enter in default. When they enter the default, what will happen? Who suffer next? Is the institution, banks, the brokers also suffer. So the last leg was the Lehman crisis. So what can you see? Is there any similarity here today? Okay, so what you can do is that to understand people, you just replace the word subprime with COVID-19 crisis. Okay, so this is this year, last 2 years chart, including this year up to April. Now, what you could see that market also trending very nicely, exactly like 2008. Then suddenly something happened because of COVID-19. Now the market is just amazing. It dropped 38% to be exact, 38% across all the indices. Okay, it dropped 38%, but guess what? It's not within 2 months. It's within 6 weeks. The market dropped 38%. So earlier I explained about the behavior science is that when the market dropped too much, too soon at a very short time, it sent a shock wave to the world. Okay, why is it to the world? Because US market is still the #1 financial market in the world. So this is what happened right now. And of course, the Fed do is whatever measures it help the market recover very strongly. So what I need yourself or even myself, what am I looking out for the next few weeks to the next few months is this. There are 2 things. The first thing is that I got to ask myself, yes, market may break the roof and continue to go up, but as long as these 2 things in my mind and I observe is still there, I'm going to be very cautious to buy and hold it for too long term. Okay. Now, these 2 things I'm going to observe is that I'm going to ask myself from time to time, week to week, month to month, as it passes. I'm going to ask myself this question: has the core issue disappeared or resolved, which is the COVID-19? Okay. Now then the number two is that I'm going to observe the global environment, especially in the US and the G7 or the G20, the global and their companies. Is there more and more defaults? Are there more and more companies bankruptcy that's going on? If the answer is yes, then I will not be too optimistic. Yes, according to trend in the short term, all this and that is still going up, but I'll be very cautious. I'll make sure that I trade a bit on the shorter term, that once it starts to turn, I have to clear as much as I could, as fast as I could on my long positions. And definitely on my long-term position on the buy side, I'll be very, very cautious. Okay, so that is my take. And these are the two things I'll be looking out for the days to come, weeks to come, and in fact, month to come. Okay, so today Dow Jones have traded around 27,500, and I understand that right now the market has dropped about 3,000 points. So the next few months it will be crucial. Okay, so now let me discuss about tonight I said I'm going to share about two parts. The first part I'm going to share with you the bull market, how the blue chip and the small cap behave. Now in the bull market, usually the blue chip will pick up first, then the last leg will be the small cap. Okay, I'll explain to you how it works. Then after that, towards the end, I will share with you the second part. The second part will be in the potential bear market. Okay, now then who will move first? In the potential bear market, my observation over the years is that the smaller guys will fall first. So once a smaller guy falls, as long as the data remain weak, I'm not too optimistic, because subsequently the behavior science tells me that when the smaller guy falls, if it falls for too long, too much, and too many of them, gradually the big guys will pick up as well. Okay, so this is what we're gonna discuss tonight. Now the first part is this. Now in a bull market, say for example, we have entered the crisis, market was very bad. In the potential bull market about to come. Now usually there are this flow. The first one would be the policy, which is a central bank. Sorry, the central bank and the environment. Now, if the central bank or the government doing the right thing, is the environment conducive enough to implicate a potential bull market? Okay, so if they're doing the right things, then the next will be followed by business and the blue chip stock. They are tied together. Then after that, they'll follow by property. And when the property get too expensive, there will be still speculators, investors want to get in. Then they will speculate the small cap, because small cap are still cheaper to do it. So that's the flow of what I have understand. So this is exclusive, and this is what I've designed and what I've understand over the years. I just put it into perspective. Okay, now let's look at the actual market back then. When it was in 2008 crisis, when the market fall, the first QE was in November 2008, as you could see. Then shortly later, after a month, the Fed cut the rate to all-time low to about 0.25. Now it took about 3 months later. Now, so the policy did the right thing, okay. But 3 months later, then the blue chip bottom up and start to rally, okay, until January this year. Now, so the policy was right. In December 2008, Fed reduced the interest rate to 0.25, the lowest ever, and it was unprecedented for 7 good years. And because of the interest rate was very low, the stock market also rallied, then followed by the property market. Okay, so of course, then after that it went up, and now it's back down again because we have big issue in the financial market. Now, so I still remember the flow. Policy followed by business and stocks, so they pick up. Okay, 3 months later they pick up. Now guess what happened to as business prosper, then stock market goes up, investor invest in business, they make money from stock market, so they are a bit more no longer cash tight, they are more free up, they are more wealthier, they look for investment after investment. So the other investment, which is a bigger investment for all of us, will be, hey, let's buy some properties. Okay, so this is the flow of a bull market. Now you could see that after the first QE, followed by Fed, 3 months later the stock market bottom, then the stock market boom, and then followed by the property market. Now the property market, let's look at was the stock market bottom in March 2009. Then 2 years later, the property market bottom. That's for US. Then of course right now is still around the all-time high. Yeah, and it has rallied. Okay, now can you see the flow of things? Good policy, good environment is conducive. 3 months later, the stock market bottom up. I'm referring to the US market. Then 2 years later, the property market bottom up. And this is where we are today in the US stock property market. Is still around the high. Now next we go to the small cap. So what happened to the small cap back then? So are they being left out? Not exactly, but let's study into the small cap right now. Sorry. Okay, so what is this? One of the best benchmark to study and understand small cap is we look into the Russell 2000 index. Whether it's a cash or futures, they are the same. The futures may make the cash. Okay, so now what is Russell 2000 index? It is an index that measures the performance of about 2,000 smallest cap American companies in the Russell 3000 index. Now, so this is small caps, mid cap, small caps of the listed stock in US market. Also, let's study into how the small cap catch up subsequently. Now, John Templeton said this: in a bull market, it was born on pessimism, grown on skepticism, matured on optimism, and died on euphoria. So we're going to study about the euphoria that's happening after Trump won the presidency election. Then I also impressed by this statement. I also invented my own bear statement. Now, so it kind of coincide with each other, the Dow and euphoric, and start with greed. It kind of coincide. So I say that the bear market will start with greed, followed by confusion, sell on fear, and end with hopelessness. So I just felt that we are a transition right now. The bull and bear, there's some transition. We've been through a stage of euphoria, and now there's a bit of confusion here. Okay, now let me explain to you what I see in the market. Let me just go to the next slide. Okay, you could see that that was after 2008 for the US market. So market are generally on a growth stage to somewhat maturity there. Okay, so growth stage to maturity, and then after that there was a period of euphoric move. Now, how do I classify that the market is euphoric? So basically on the growth stage, you could see the gradient is about 45 or slightly 45 degree. How can I tell when the market is euphoria? When the market is euphoric, you can see that the gradient is so much steeper from the growth stage. You got a sense that the market are chasing after something. You know, they don't care about the value anymore. They just want to buy it because of FOMO. What is FOMO? FOMO refer to fear on missing out. So they just don't care about the price. They will race after the market. Now we are going to study this period. Very interesting period, the market euphoria. Now, what do I mean by that? Now, it was triggered because of Donald Trump won the election in November 2016. Okay, and then of course he promised a 20% tax cut, and it happened. So the market rallied. 20% tax cut means that 20% increase in the company net profit, something like that. Okay, so now during this period the market rallied, so there was this euphoria. It was good. So I'm going to study between these two periods, which is because that's the trough of the euphoria move. The trough was in January 2016, and the top side, it ended with trade war. Now, after the trade war being announced, it was somewhere about in July 2018. You could see that the market started to enter into a huge range, and that's why I call the confusion state, the confusion stage even today. You still remember what I said for the bear market on the behavior side statement? It started with greed and followed by confusion. So we're now at a confusion stage right now. Some say it's going up, some say no, it's not going up. So we're going to study into that in a short while. Now we're going to study between these two periods from Jan to September 2018, Jan 16. So that is about 3 years. Now this euphoria, market euphoria, lasted for 3 years. Now next, let's look at different market. Let's look at the Dow Jones. Oops. Okay. Now we're going to study just this period from Jan 2016 to September 2018, you could see that all Dow Jones, S&P, and Nasdaq rallied tremendously. Okay, now Nasdaq is special because of it's a new economy, it's e-commerce, it's the tech, so naturally it's going to rally. Now let's look at during this period, just this 3 years period. Now what happened to Russell? Okay, now Russell also do its catch up, and also much stronger compared to the Dow Jones and S&P. So I'm going to exclude Nasdaq because Nasdaq is different. Okay, so I would say that Russell compared to S&P and Dow Jones are the same league. It's just that they are a smaller cap company. So Nasdaq is a bit different creature because they are the future of the world. Okay, so they are all the tech stocks, whatever. Now you could see that, like what I say, the flow of the rotational play in the market, in the bull market, is first started with blue chip, then to property, then the last leg would be the small cap. You could see that. Now the interesting part about this whole picture is here. Now the market peaked in January 2020 this year. Now after September 18, the Dow Jones continued to go up despite of the trade war. So is the S&P, and so is the Nasdaq. But now let's look at January is here. Now, all these three markets have broken the September 2018 high, except for Russell. Okay, so this is what we're going to discuss that on the second part. Okay, so if you can, this presentation is just about an hour. Stay with me till the end of this hour. Okay, so I'm going to take the last 15 minutes for Q&A. So we're going to discuss about why I say that in the potential bear market, usually the small cap will move first, then followed by all the blue chip. Okay, now, so how are we going to handle this period of uncertainty and great volatility? Okay, so this is my take. Of course, can you trade the Russell 2000? No, you can't. Just like since I'm here in Singapore, just like let me give you a proposition here is that can you trade the STI? If you find that to buy the individual stock is too much of a hassle to choose from. But my next question is that can you trade the STI? You can't. Yeah, you cannot. But if I have a subset called the STI futures, I could trade the STI. So same thing that I think the Russell is getting very, very interesting. But can you trade the Russell? Of course you could. You can buy up to 2,000 companies, but that is going to cost you a lot and it's not efficient at all. So therefore, there's this subset of instrument called the Russell futures. So between the two, there's this E-mini Russells. There's also this Micro Russells as well. Okay. Now you could see that this is just a demonstration of one-day volume. During the Asia time zone, it was packed with liquidity, and the night market, it just flew. Okay. The light blue line, it represents the Micro Russell. Okay. Micro E-mini Russell, and this gray lines, it represent the E-mini Russells. I could see that this is a monthly chart. Over the last, this is the latest, this is May, April, March, Feb, and Jan. Starting this year, as the market get more and more uncertain and more volatile, you could see that there's more and more interest on the mini Russell. So I also want to take an opportunity, not just because of CME sponsor, but I also want you to take a look at the different market as well, that globally is gaining a lot of traction and interest. And you also have to understand why are people looking at mini Russell right now. Okay, there's a reason for everything. So for those that are interested to get involved in either mini Russell or micro mini Russell, let me just give you I'm just going to take the next 5 minutes to talk about how to understand the product. So if you have been trading the futures, but it's been not too well, I mean that you don't see a positive yield in what you're trading. Maybe you're trading too big, too sizable. Maybe you should reduce your size. So something about trading is this: you have to understand that don't let your emotion take over the decision. Okay, so the emotion should not be there. So I studied into a lot about technical analysis, but how I do it is that technical analysis, I view it in the perspective of behavioral science. So of course there's up and down day. Down day will not affect a lot because I trade within my means. So if, of course, I hope in trading is this, I hope to accumulate more of the small gains and lesser of the smaller losses. It's all about less, but less is more. Trading is never about making a lot of money in the shortest time. Okay, trading is about accumulating small gains and also have a measured risk on risking small losses. So, but you focus on more small gains. That's about trading. Now, let me just introduce you to the smallest product of Russell called the Micro E-mini. Now, how it works is this: to understand a contract, there's two tricks that I'm going to share with you. The number one is that you have to understand contract specification. Now, this applies to all the market, all the futures market, and all the contracts around. You just have to know two things, then you're good to go. Really, okay? Just 5 minutes. Understand these two things, you're good to go. The first one is that you have to understand the contract specs. Now, what is the meaning of contract specs? Contract spec, it means that what is the minimum movement and how much it is worth. Now, in the contract specs crafted by CME, it says that the minimum movement for Russell is 0.1. Every time it moves by 0.1 point, it means that you may make or lose $50. But I just want to make it a bit easier to understand is you just convert 0.1 to 1. So basically times 10, right? So when it times 10 means that 1 full point is equal to $5. That's all, okay? Now, so the next one is that there's two things I want you to know. The first one is the contract specs. When you trade something, you have to understand what are you buying and selling. Now, the next thing is that, of course, whenever you buy or you short the market, there's always a price. Now, so what does it mean? The next things that I say there's two keys. The first key is contract specs. The second key you have to understand is called the contract value. Now, this is very important. If you see that at 1,005 you're going to buy tonight in the Micro E-mini Russell, what does it mean? Since 1 point is $5, it means that at 1,005 times 5, you're literally buying a 2,000 small caps, mid cap, small caps companies in US worth $7,500. This is what it means. So it's very meaty. For those who do not understand how it works, they find that it's dangerous, it's leverage trading. No, yes, it's leverage, but whatever you buy, say you buy one Micro Mini Russell, you have to understand you're engaging a 7,500 worth of 2,000 small companies. That's all. Then of course there'll be margin. It states that you have to come in $7,500 to pick up 7,500, 2,000 shares. You do not have to. You can put in $705 as a margin to participate in the $7,500 worth. Of course, if you want to do it, you can, but I will not recommend you because you're trading very thinly. So you could, but usually what I do is that, say for example, I'm interested to trade the Micro E-mini. From your perspective, I will put $10,000, and I see there's opportunity. Of course, you can trade with $10,000. You can trade up to easily 10 lots, right? But I'm just going to trade 1 or 2 lots or 3 lots. That's about it. Okay, so this is how I manage it. But you don't have to do that. But I also do not recommend you to trade very thinly. Okay. Now, I'm just going to move on to the next segment. That I'm going to wrap things out to showcase to you how the small cap is going to lead the blue chip. Is so exciting, so amazing. Now, the next thing about whenever there's volatility and uncertainty, I will always look at more of the derivative. Now, let me just share with you a story here that even in the bull market, how I manage my portfolio is this. In the bull market, say I'm still quite young. I'm 48 this year, so I consider myself young. You could see that I believe we can in our generation, most of us can live up to 100 years old. Okay, so I'm just less than halfway mark. So now in a bull market, what I do is that means I'll be fully invested in a bull market or potential bull. Say for example, the bull market, I'll be having about 90% of it in the asset class. It could be equities and a lot of asset class. Then it's always about 10% our pocket to have a margin trading account on derivatives or whatever sort. There's always 10% because
there will be volatility. I also want to make some from the volatility. Although bull market is here, I'm going to hold my assets and let it hold, and also invest along the way to grow my assets. But there's always a 10% that I will put in the margin account. Now, what happened when the market became uncertain, volatile, and become bearish? Now then, this assets of 90%, I'm going to shrink it because market is uncertain. I've not much idea whether my investment is going to grow. I'm going to shrink it. From 90, I may shrink it to 50 or more. Now, what about my margin account? When the market is volatile and uncertain, it means there's more opportunity. I'm going to increase my 10% to about 30%, and that's all I'm going to increase. Okay, why is this picture? Because 2 years ago, I did this talk with IOSCO. Now, who is IOSCO? They are the global regulators. So I spoke on the subject about active investment with derivatives. And 1 hour of our panel discussion, this gentleman gave a parallel comparison. He said that he finally understands what is all these derivatives. He said that derivatives is something like eating chili padi. Now, chili padi, either you like it or you don't like it. If you like it, you will take it. But even you like it, you cannot have too much of it. Okay. Say, for example, when he drink a bowl of fish soup, it's always good to have a teaspoon or less of chili padi in the fish soup, and you just enhance the flavor. But you cannot have 1 tablespoon of chili padi and put it on your fish soup. It will kill the taste. So exactly on derivative, whether is it bull time, uncertain time, or bear market, I always have a fraction of my managed fund I put in the derivatives. Especially uncertain time and bear market, I'm going to increase what I have for the derivatives. Yeah, so this about derivative, always have something in mind. Now, in a uncertain market, yes, I'm going to increase my portfolio in the derivative, but there's another assets that I would like to increase, and that is in gold and precious metal. Okay, so in 2015 October, I posted a blog, and those that knows me, that you know that on 2015 and onwards, I'll be talking about gold. I want to invest in gold, and then was investing in gold. I'm not trading in gold yet. So in a challenging market, volatile market, I will always look at a safe haven, which is gold. You can read about my blog. The link is there, and how I stitch between the technical analysis or the behavioral science with the fundamental development. So I still remember in 2015, I was in Hong Kong. I presented this topic about buying gold or start investing in gold to a group of fund managers in HKSI. And it didn't sit very well with the fund managers because they felt that gold is not a dividend kind of assets. So yes, it's true, but my focus was more on a capital gain than an income strategy. So, but it didn't speak very well to them. But after the session, the founder of that fund manager house, he appreciated more than his fund managers because he'd been through cycles, so he knows what I'm talking about. So that was in October 2015 gold. In an uncertain period, I would like to focus more on gold. And since then, from October 2015 until today, I have been investing in some golds. And now market is finally getting interesting and much more volatile. Now, when the market is interesting and volatile, I will start to not just invest in gold, I will trade gold as well. Okay, so I think in Singapore scene, we're quite I did a survey 10 years ago when I asked this question to auditorium of investor. I asked them, do you enjoy volatility? And they, or do you like volatility? Most of them say no. I think about 70% will say no, they don't like, they do not welcome volatility. So I did this survey in the same auditorium in SGX to a group of about 100 investors and traders. And today, before the pandemic, that was end of last year, I asked them the same question: do you like volatility? And to my surprise, that in today's market, the investor, the environment, the community, the people generally, in fact, about 50% say that they welcome volatility, and they say that because when there's volatility, there's trading opportunity or investment opportunity. I begin to realize that over the years for Singapore community, the investor and traders community, we have grown so much that we became more sophisticated, that we enjoy volatility. Volatility may not be a bad thing. Okay, but tonight my topic is beyond volatility. I felt that, let me just give it to you right now, there's still a potential risk. I say potential risk, okay, that the bear market is still lingers around, and maybe it's just the beginning. Okay, now let me just present to you how it works. But before that, I share with you the micro goal. Okay, this is how it works. So you know the steps, the contract specs, and there's a value. And every time you buy into a micro E-mini goal, there's always a value. Currently is at 16,800. That's the full value of it. Okay, now I'm going to give you the last part. Okay, not forgetting that you could see once again in 2019 the gold started to pick up, the volume, the interest start to flow. Okay, so gold is ahead of time. Okay, so in terms of the potential bear, gold is ahead of time. Okay, so I just going to move on to the highlight for tonight. Is that in a potential bear market, now my observation is this: in a potential bear market, the small cap leads. Okay, in fact, my title is a leading small cap. You know, US Russell index is small cap. It's a leading indicator of US major indices. Now I'm going to reveal how it works here. Okay, now so in the inversely, in the potential bear, what happened is this: either the policy fail, okay, or the environment are not conducive at all. Then after that, followed by all the small caps and small companies struggles. Okay, when the small companies struggle for too long, the blue chip also suffer subsequently. Okay, so this is the flow of things in the potential bear market. Now, so what I'll be watching very closely over the next few days, next few weeks, or next few months globally is this. Okay, remember just now I said two things. The first one is the core problem, is it still lingers around. Okay, the number two is the not just in Singapore but globally, because Singapore is just a small island. Our GDP is very small. We still depend on the world. Okay, and if the world happen that more and more company fails, then we will not have a good time as well. I would say that we'll be in trouble because I think our whole system are flooded with not easy cash but solid cash. Okay, so our system are not flooded with easy cash but solid cash. So we will not suffer, but we will be in kind of a hardship as well. So now this is not the latest. What you could do is that just go and Google. You may go to this source here. And this is in March. You're going to compare to the previous and last month is if that country, especially in US, the G7 country, will you see more and more companies filing for bankruptcy? So this is a sign that you got to keep track of things. Now let's study about small cap, whether it's in Singapore. I would say that this statistic apply to most of the developed country. Those US stocks that that is very popular, the Google, the Amazon, the Apple, is just 11% of the whole market pie. Now then the rest, okay, the rest made up of about 90% of the market pie, where is a lot of companies fall into mid and small cap. But what we know are the few good ones. We keep track of Dow Jones, we keep track of Nasdaq and S&P, but it mostly represent all the large cap. So a lot of us do not look at the Russell, and it's so important because the Russell represent the major part of the market cap of the whole US stock market. Now, it represents about 90%. It also employ about 70% of the whole force, the whole workforce. So this number is true in US. It is also true in Singapore. So that's why you see that for Singapore, the Singapore government, why are they so, there's so much urgency. They take every measures to protect the SME that they cannot, I won't say they cannot fail, but they try to hold them together, because if a lot of SME fail, so what happens is that we're going to see a lot of people unemployed on the street. So they do not want that to happen. So, but the key is this. We got to observe all these small cap, mid cap companies in US, in a G7 nation, because if more and more fail, then there'll be a lot of social issue. So the recent social issue, the Main Street, you may find that there's a Wall Street and Main Street divergence, which is true. I think it's so attribute to a lot of social issue as well. Okay. So let's look at the market right now. This is so exciting. Now, so now we study this period for 3 years. For 3 years, we find it just interesting. Now, so the market peaked in January 2020 for Dow Jones, S&P, Nasdaq, but not for the Russell. Okay, not for the Russell. So my proposition is this. So has the bull loses its momentum? And my answer is yes. Okay, but beyond that, let me show you the next studies that I have. Let's look at the don't focus your eyes everywhere. Just follow what I say first. Okay, now let's study the Nasdaq. Now Nasdaq is a different creature. It's the future of the world. Okay, at least for the next 50 years, I guess. Okay, now you could see that if I draw a very simple trend line, it tracked very nicely along this trend line, and of course, since 2016, things have changed. E-commerce platform became so robust, it set a new trend. So you could see that it behaved very nicely along this super trend. Now let's look at the S&P. Now S&P since 2008, it also trend along this beautifully along this trend line. But something happened in February or in March. February it was this move. March was this move. It break below this trend line, but the thing is that in March it closed above or at the trend line, so it kind of sit well. That's for S&P, right? Now let's look at the Dow Jones. Dow Jones also kind of trend along nicely on this trend line, and same thing for March. It broke below, but it's always if you study the candlestick and understand, we always focus on the closing price. Now if you want to understand more about all these, please go to this link below. So these are free, and I make it free for the time being. Please go and view it if you can. I'm not sure if I'm going to charge it. Maybe, okay, but it's free for the time being. So I did this for CME as well, about how to identify market reversal. So go and view it. It's about 15 minutes program, and it's pretty popular. Okay. Now, so for Dow Jones, it tracked along this uptrend. It break below, but it closed above or at the trend line. Okay, so I take it as all these three big boys are doing well for the time being. But earlier I explained about the potential bear market. Who will fall first? The small cap company will fall first. Then there's a chain of effect. So I'm not suggesting that we have entered into the bear, but I'm very cautious that the bull is getting very tired. I'm very cautious that if I'm going to buy and hold for too long, I'm going to be very cautious. So I'm going to keep my I have entered into a trading mode. That means I get in and get out fast. Say hold for a few days, or if I intend to hold for a few weeks, I will hold for a few weeks, but I have to be very sensitive on any potential threat on the south. Once it happens, I have to clear it as fast as I can. Okay. Now let's look at the Russell. If I'm going to draw the similar trend line, you could observe that in the month of March, it closed below this uptrend. This is the only market that closed below this uptrend. Of course, now it's doing a rebound, which I explained that this rebound fundamentally that's still not right to me. Okay, so you know that I've explained. So fundamentally it's not right, although there's rebound. So therefore I suggest that we stay very cautious on this bull. But the small cap already indicated to me are not doing that well. Okay, so when will it be basically out of the blue is this. Now along the timeline, yes, Nasdaq today have broke its high. Along the timeline, the S&P and Dow Jones may break the high, but I want to be convinced that the small cap also closed above the previous high for me to know that, to acknowledge that is a resume of this super bull that we've seen since 2008. So this is what I'm going to keep track. Small cap, just to recap here, is that small cap, it represents about 90% of all the listed stock. It's not just all the listed stock, you also represent the unlisted stock of the SME as well. Okay, so they are important. They are the major fabric of the whole economy. So never underestimate them. So, but the Russell also indicate that all these SME for the time being are not doing too well. It's not back on track on this bull market yet. Okay, so this is my take, and I hope you enjoy that. So again, we're going to enter into Q&A, but before that, some of you may have to leave. just want to leave you with some good reference. Like what I say, you can visit Weipedia.com. The last session I did with Phillip, that was last year, I think in September. I talk about the market reversal. If you could go and look for this e-learning, you're able to see this identified market reversal. And of course, not forgetting, do visit cmegroup.com /education. They have a lot of good programs offered to you. Okay. Next one, who like my Facebook or follow my Facebook page? I post news article opinion on a daily basis every weekday. So what I do is that I enjoy reading news. I want to gain insight what's happening around the world. Those news that I caught my attention, I'll share it anyway. I will summarize that. I'll give you my opinion. So do follow if you can. Okay. So, and also you can like my YouTube and Instagram. Lastly, you can always email me if you have some idea about some unusual behavior that you see in the market. Just drop me a note, okay? I really appreciate that. If you can drop me what you see, that will help me to spot for unusual behavior as well. So with that, I'm just gonna turn this time to Street. At any question that you find is real interesting, especially reference to tonight's topic. Yeah.
I believe everyone was thoroughly engaged with the webinar because I don't have any questions yet. So this is a good time to pen down your thoughts. If you have any queries for our financial expert today, this is the best time to send them into the question box. You see on your control panel, it's somewhere at the bottom that says questions. You can type in your questions right there, and we will address them as we see it, as long as there's time. And thank you once again for being a wonderful audience and for tuning into this webinar. CME Group, proudly supported by CME Group, and we are covering our CME E-mini Russell today. All right, so we have the first question on hand. The first question is from CT Ling. Hi, Kon Hao. May I know what is your view for gold trading?
Okay, let me just bring you back to the chart earlier about gold. Okay, when we trade the market, we have to be very specific. Are we trading or are we investing? So like what I say, in 2015 October, I stopped the blog about gold. I went around to speak about gold for gold investment. Okay, so it means that you buy into gold ETF, you buy gold bar, you buy mining companies, and you hold for long term. So, but as you could see that as it started to break above this neckline about 1350, and it kind of make a U-turn about gold, and it's not just fundamental, but technically, I believe that gold is on the way up. Now, those that I've bought in 2015 and onwards, now you may ask me, am I still holding it? My answer to you is yes. I'm still holding my gold because back then in 2015 or 16, so to speak, that I started to invest in gold. I have this. I prepare it as a long-term investing. Okay, so if you can go to my website, I have this segment called the trade profiling. Go and read them, study them, attempt the survey, attempt the 10 question. I advocate that whatever we do, whatever opportunity that we see, before we buy them, we have to profile what is it for. So then the goal, I position it as a long-term investing. Long-term investing means that I want to hold for at least 3 years and more. Now, so those investment part that I'm holding in the gold, I still want to hold it because as the market develops, the fundamentals speak to me even well. But the beautiful part is that I got hold of the base about 1002, and along the way, I will trade them. Along the way, I will invest more. I will do a dollar averaging up because I want to buy long term. Now, so as it broke above 1350 market, you could see that it get a bit more volatile. So when the market is start to volatile, I don't just invest in them. That means I'll still hold that, but I will trade them. That means trading is different strategy. Trading, earlier I say that it's all these small accumulated gains that make much to it. So now, if you ask me about my goal direction, long term, I'm still seeing up, and short term, I will buy on dips. So that's my strategy for the goal. So any other questions that you have?
All right, we have another question here. This is probably a recap question. What were the two factors you are most concerned about when the bear market comes? What kind of time frame will you use, and how long would that possibly be for?
Okay, I think the two concerns, a recap is that I'm not suggesting that the bear is already here, but I'm just felt that the bull is a very tired bull. And let me just do another recap here is that in February to March, 6 weeks, the market, I'm talking about the three big boys, within 6 weeks, the market collapsed 38%. So at the beginning, I say that when the market collapsed too deep at the shortest time, is unhealthy for the market because there's too much blood at a very short time. And let me just give you another illustration here in Singapore. Here is that when that happened because of COVID-19, then subsequently you also affect the oil because flight is inbound and consumption of oil is at the lowest. Then there's this fight between Saudi and Russia. So there's contagion effect that then it also hit the oil price, and then it also hit our local guys. Thankfully it's not listed, called the Hin Leong. Okay, so you can see the contagion effect there. So that's what I mean by when it happened too fast, too quick, there's no time for reaction. And to study the market, usually when I look at a major turnaround here is that I want to look out for the beginning of the turnaround. Usually is start with a crack. This is what I call a start with a crack. Then subsequently market will enter into a phase of confusion, which is right now. But the crack is already there. So I still want to eyeball on the crack, which happened in January, February, and March. The crack has already happened. So now the market is a bit confusion, and I believe some of you, if you're a private banker, your private banker already email you and call you, it's time to buy. Okay, but I would say that please don't fall into their trap. And it's always good that, yes, attend all the seminars, you can listen to their opinions. But the more important thing is this, that as you listen to the different opinions, you also need to derive your own opinion. And deeper than that, that when you have opinion, can you derive it to the such that it's become a conviction? That means you're quite confident and quite sure. That means you take all the opinions. I may be a contrarian to your bankers, okay, because the bankers have certain objective I do not have. So yeah, I'm an independent bodies. So but whatever I present to you, I think it makes a lot of sense. So you must have a full conviction. So my conviction in short is this: I felt that there was a crack since January, February, March, and the crack is too deep. So it's a first signal. So now we're entering into a stage of confusion. So I'm going to keep my ears, my eyes, and my heart open to the two variables I just talked about. Number one is that the core issue is still there. If it's still standing, number two is that I'm going to keep watch in weeks and months to come. What are the health of all these companies around? Why? Because all these companies who are the SME, they employ up to about 70% or above 70%. In Singapore case, okay, our S&P employs 90% of our whole Singapore workforce. Okay, if just to share with you this statistic. So the S&P are very important. They should not fail. I hope they will not fail. Or I'm referring not all of them, but of course many of them. Okay, so that's a very important question. So maybe we have time to take the last questions.
Yes, this is a very interesting question. It's probably something everyone is wondering right now. This is from Steven. Steven is asking, US markets are still very bullish and the Dow is trending near 30,000 and Nasdaq is more bullish despite so many headwinds. Kindly share what is the main cause? Is it Trump?
Oh, okay. Yes, what are the two main reasons? Okay, I think earlier I shared with you about what to keep an eyeball on moving forward, right? That's the two reasons. I think I spoke at length. Now I got to share with you. So this question basically in short is that I just summarize your question here is that, Kon Hao, what are the two major reasons for this rally? Or what are the reasons for this rally since March? Okay, I have two. The first one is Fed. FED, Fed. Okay. Now, Fed did the unprecedented stimulus. I think, let me just read to you, it's almost crazy what they have done. It's beyond the 2008 QE. Okay, what they are doing here is that Fed, they pump trillions of dollars, and Fed slashed interest rate to almost zero in the coming meeting. promised to buy unlimited amount of bonds, roll out a series of emergency programs, which is good, or which was good, and is directing the purchase of junk bonds. So now, first one, the market have rallied because Fed did the right thing, but I think but I'm not exactly, is a good thing, but I'm not exactly sure is it a right thing to do. Okay, what Fed are doing, to me, is a very desperate measure. Now, what caused the rally are two things. One is called Fed, F-E-D. The other one is called the F-O-M-O, the fear of missing out. Okay, I can share with you that the Americans, the assets are different from, the investors are different from us, the Asian. In Asia, we invest in properties. But the Americans, they don't invest in properties, they invest in stock market. So the more well-to-do, the upper middle class, they will have, their assets are mostly on stocks. So they do have experience in 2008, because 2008, you know, that it was a V-shaped recovery. So it's still quite fresh to the baby boomers. It's still very fresh to them. So it's very similar to 2008. So when the market starts to rebound, many of them are chasing after the stock market quite blindly because of fear of missing out. They have the experience in 2008. A lot of them missed the low or around the low. Okay, so this time around they want to participate, but I can tell you that it doesn't represent the other group of Americans where I have this term called the Wall Street and Main Street divergence. What do you mean by that? Wall Street is on the rally, but look at the Main Street of United States is in the chaos right now. So these people on the street that you're seeing, do they owe any stocks? They don't. Okay, they are the lower income group. They don't have the stock. So whatever the stock moving up is, there's nothing to do with them. So there's a lot of like what I said, pandemic will also trigger a lot of underlying issue right now. So this is another aspect maybe you may want to take a look at. But don't be too pessimistic. Like what I say, it's always good to know, always good to be cautious, so that when things happen, you don't get caught. But I just want to bring a point to you very clearly before I end here, is that volatility is here to stay, I think, for not for the next few months, but for many good years to come. Okay, so do enjoy volatility. Don't fear them, but manage them correctly and be guarded for on your investment portfolio. Okay, so with that, I want to thank you for all the 180 participants that stayed through with me over the last 1 hour. And thank you so much, and I hope to see you around. With that, I just want to hand this time back to Sri and also Rachel Wong from CME, if any things to brief our audience here today.
All right, thank you so much, Kon Hao, and thank you for being a wonderful audience. Rest assured, as usual, we will share the link to the video recording in our follow-up email. For those questions that we have quite a few, we received in the last few minutes. For those questions that we couldn't address, rest assured, we'll follow up with you offline. All right, thank you for being a wonderful audience. Do look out for our next webinar, and we'll catch you then. Good night. Bye-bye.